Before we begin, it's crucial to understand that the information presented in this video is for educational purposes only and should not be considered financial advice. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all individuals. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. This presentation is not an offer or solicitation to buy or sell any financial instrument. Have you ever opened a financial chart and felt your brain just short-circuit? It's a chaotic wall of green and red, a jumble of jagged lines and cryptic numbers that looks more like a heart monitor during a zombie apocalypse than a map of financial markets. You're not alone. That feeling of being completely and utterly overwhelmed is the #1 reason most people click away, convinced that this world is only for Wall Street geniuses with 6 monitors and a direct line to the universe. But what if I told you that this chaos is actually a language? A story being written second by second that reveals a global battle between buyers and sellers. And today you're going to learn how to read it. We're talking about the Forex market, where over $7 trillion change hands every single day. That's more than the New York Stock Exchange, the Tokyo Stock Exchange, and the London Stock Exchange combined. It is the largest, most liquid market on the planet. And all of that massive global activity, all of that economic energy, is visualized on the very charts that seem so intimidating. The goal of this series is simple: to transform that confusion into confidence. We're going to strip away the complexity, ignore the noise, and give you the foundational skill that every single trader, from the beginner to the billion-dollar hedge fund manager, has to master first: reading the chart. By the end of this video, you won't just see lines and colors, you'll see a story. You'll understand the narrative of price. So let's start at the very beginning. What is a chart? At its core, a financial chart is just a simple graph. That's it. It has 2 axes. The horizontal axis at the bottom represents time. This could be seconds, minutes, hours, days, or even years. The vertical axis on the side represents price. So all a chart really does is show you how the price of something, in our case a currency pair like the euro versus the US dollar, has moved over a period of time. It's a historical record of price. Now there are a few ways to draw this story. The simplest is a line chart. You've seen these everywhere, from news reports to your fitness app. It just connects the closing prices over a period of time with a single continuous line. It's clean, it's simple, and it gives you a great bird's eye view of the general trend. But it's a little too simple. It leaves out a ton of important information. It tells you where the price ended, but it doesn't tell you anything about the drama that happened along the way. That's why most traders use something far more detailed. The most popular by a landslide are Japanese candlestick charts. And this is where we're going to spend our time, because if you can read a candlestick, you can understand the heartbeat of the market. Don't let the name intimidate you. A candlestick looks complicated at first, but it's incredibly simple and tells a rich, 4-part story all in one little shape. Imagine you're looking at just one of these candles. Each candle represents a specific chunk of time. Let's say 1 hour. In that 1 hour period, that single candle will tell you 4 key pieces of information: where the price started, where it finished, the highest point it reached, and the lowest point it touched. Let's break down its anatomy. A candlestick has 2 main parts: the thick part, called the body, and the thin lines sticking out of the top and bottom, called the wicks or shadows. First, let's talk about the body. The body tells you the story of where the price opened and where it closed for that time period. The color of the body is your first and most important clue. Typically, you'll see green and red candles. A green candle means the price closed higher than it opened. Think of it like a green traffic light. Go! Price went up. This is called a bullish candle, because bulls thrust their horns up. A red candle is the opposite. It means the price closed lower than it opened. Think of a red stop sign. Stop! Price went down. This is a bearish candle, because bears swipe their paws down. So, at a single glance, just by looking at the color of the candle, you instantly know whether the buyers or the sellers won the battle for that specific period of time. Green means the buyers, the bulls, were in control and pushed the price up. Red means the sellers, the bears, were in control and pushed the price down. Simple, right? Green up, red down. You've already learned half the language. Now for the second part. Those thin lines, the wicks. The wicks tell the rest of the story, the full range of the battle. The very tip of the top wick shows you the absolute highest price that was reached during that 1 hour period. And the very bottom of the lower wick shows you the absolute lowest price that was reached. Think of it this way. The body shows you who won the war, buyers or sellers. The wicks show you all the battles that were fought along the way. For example, if you see a green candle with a very long upper wick, what does that tell you? It tells you that during that hour the buyers pushed the price way up, that's the high point of the wick. But before the hour was over, the sellers fought back and pushed the price back down a bit before it finally closed. So even though the buyers won the hour because the candle is green, that long upper wick is a clue that the sellers put up a serious fight. It's a story of a struggle. Conversely, if you see a red candle with a long lower wick, it tells you that sellers pushed the price way down, but the buyers stepped in and fought back, pushing the price up from its lows before the session ended. It's a footprint in the sand, showing you where the market tried to go but failed. This is why candlesticks are so powerful. A simple line chart just gives you one data point. A single candlestick gives you 4. And it paints a visual picture of the tug-of-war between buying pressure and selling pressure. When you see a long solid green candle with tiny wicks, that's not just a green bar. That's a story of overwhelming, confident buying. It's a market that opened, buyers took control immediately, and they never let go, closing near the absolute high. It's pure momentum. The final piece of this foundational puzzle is the concept of time frames. Each candle on your chart represents one period of time, but you get to choose what that period is. You can set your chart to a 1-minute time frame, where each candle tells the story of 1 minute. Or you can switch to a 1-hour chart, where each candle represents a full hour of activity. Or a daily chart, where each candle represents an entire 24-hour day of trading. This is like using Google Maps. The daily chart is the satellite view. It shows you the major highways, the big cities, the overall landscape. It tells you the long-term story. Are we generally in a mountain range heading up? Or are we in a valley heading down? Then you can zoom in. The 1-hour chart is like the city view. You start to see the major streets and neighborhoods. You see the story with more detail. The 1-minute chart is the street view. You see every single turn, every stoplight. It's the microscopic, moment-to-moment story. Professional traders look at multiple time frames because they each tell a part of a larger story. The daily chart might show a strong uptrend, but when you zoom into the 1-hour chart, you might see a temporary pullback or a short-term struggle. By understanding how to look at both the big picture and the small details, you start to get a much clearer understanding of the market's context. And that is the foundation. It's not about predicting the future with 100% certainty. It's about reading the present. It's about looking at a chart and understanding the balance of power between buyers and sellers right now. You've just learned the alphabet of the market's language. You know what a bullish candle is. You know what a bearish candle is. You know that the wicks tell the story of the struggle, and the body tells you who won. You now have the ability to look at a chart that was once pure noise and see the footprints of trillions of dollars. And this is just the beginning. Because once you can read a single candle, the next step is to see how these candles form patterns and tell even bigger stories when they are grouped together. That's where the real magic begins. Think of the Forex chart not as a series of random data points, but as the written history of a colossal battle. A battle fought every second of every day between two massive, opposing armies. On one side you have the bulls. Their goal is to push prices higher. They are the optimists, the buyers, the force of upward momentum. When you see a green candle, that's a small victory for the bulls. On the other side you have the bears. Their mission is to drag prices down. They are the pessimists, the sellers, the force of downward pressure. A red candle is a sign the bears are gaining ground. Every single candlestick you see is a report from the front lines of this war. It tells you who won the skirmish for that specific period of time, how hard they fought, and who had the upper hand at the end. But a single skirmish doesn't win a war. To understand the flow of the battle, you need to look at how these skirmishes group together. You need to look for formations, for strategies, for patterns that reveal the intentions of the armies. This is the art of reading candlestick patterns. These aren't mystical signals, they are footprints in the sand, showing the psychological state of millions of traders at once. Let's start with one of the simplest and most common stories you'll see on a chart, the story of rejection. Imagine the bears are in control. They're pushing the price down, down, down. It looks like a rout. The candle is long and red. But then something changes. Near the bottom of the price move, the bulls suddenly mount a ferocious counterattack. They completely halt the bears' advance and start pushing back with incredible force. They push the price all the way back up so that by the time the candle closes it's near where it started or even a little higher. What you're left with is a candle with a very long lower wick and a small body at the top. This pattern has a name: the hammer. Think about what it looks like. It looks like a hammer that has slammed down and created a hard bottom. The story it tells is powerful. It says, the bears tried to push the price down to this level, but they were overwhelmingly rejected by the bulls. It's a sign of a potential reversal. The selling pressure was absorbed and buying pressure took over. It's the bulls planting a flag and saying, this far and no further. Now let's flip that story on its head. Imagine the bulls are on a triumphant march. The price is soaring. Everyone is optimistic. They push the price higher and higher, creating a long green candle. But as they reach a certain peak, they run into a wall of resistance. The bears, who were waiting in ambush, launch their own counterattack. They stop the bulls dead in their tracks and start driving the price back down with immense force. By the time that period ends and the candle closes, the price has been pushed all the way back down near the opening price, leaving a small body at the bottom and a long, ominous upper wick. This is the evil twin of the hammer. It's called the shooting star. And the story it tells is just as clear. The bulls tried to conquer this new territory, but they were beaten back decisively by the bears. It's a signal of potential exhaustion. The buying momentum has faltered, and sellers have shown they are strong at this level. It's a warning shot fired across the bull's bow. These single candle stories are powerful, but the narrative gets even more compelling when two candles work together to tell a tale. Let's go back to a market where the bears are in control. You see a series of red candles showing a steady decline. Then a small unassuming red candle forms. It looks like just another day of selling. But the very next candle is a monster. A huge, powerful green candle opens lower than the previous red candle closed, and then surges upwards, closing well above where the previous red candle opened. It completely engulfs the prior candle. This is a bullish engulfing pattern. The story here is one of complete and utter reversal of power. It's not just a counterattack, it's a changing of the guard. In one single period, the buyers didn't just stop the sellers, they completely erased all of the sellers' progress from the previous period and then some. It's like one army being completely swallowed by another. It's a very visual representation of a dramatic shift in market sentiment from bearish to bullish. And of course, there is a bearish version of this story. Picture a market in a clear uptrend. Green candles are stacking up. The bulls are feeling confident. A modest green candle forms, continuing the trend. But then, the next candle tells a terrifying story for the bulls. A massive red candle opens higher than the green one closed, and then plummets downwards, closing far below where the green candle opened. It completely dwarfs and consumes the prior green candle. This is the bearish engulfing pattern. It's a sign that the party might be over. The sellers came in with such overwhelming force that they not only negated all the buyers' gains from the previous period, but they also established a powerful new downward momentum. It's a signal that the sentiment has potentially shifted from buying to aggressive selling. Now, here is the most important lesson you will learn about these patterns, and it's something that separates struggling traders from those who develop a real feel for the market. A pattern by itself means almost nothing. I'll say that again. A hammer, a shooting star, an engulfing pattern floating in the middle of a chart with no context is just noise. It's like finding a single dramatic page ripped from a novel. You have no idea if it's the climax, a flashback, or a dream sequence. The meaning, the power, the significance of a pattern is determined almost entirely by its location. It's all about context. To understand this, let's introduce two of the most fundamental concepts in chart reading: support and resistance. Think of them as invisible floors and ceilings on your chart. Support is a price level where buying pressure has historically been strong enough to overcome selling pressure and push the price back up. It's a floor. The market comes down to this level, and time again it bounces. Why? Because at that price, a flood of buyers sees value and steps in, believing it's a good deal. Resistance is the opposite. It's a price level where selling pressure has historically overwhelmed buying pressure and turned the price back down. It's a ceiling. The market rises to this level, hits its head, and falls back down. This happens because traders who bought lower start taking profits, and sellers see it as an overvalued price and begin to sell. Now let's put it all together. Imagine you see a hammer pattern forming, but it's just happening in the middle of a random price swing. It's interesting, but it's not a high conviction signal. But what if you see that exact same hammer pattern form right as the price comes down and touches a major, well-established support level, a floor that has held up multiple times in the past. Suddenly, the story is 100 times more powerful. The chart is now telling you two things that confirm each other. First, the price has reached a historical level where buyers are known to be strong. Second, a candlestick pattern has just printed that shows, in real time, a powerful rejection of sellers by buyers. The location validates the pattern, and the pattern validates the location. It's a confluence of evidence, all pointing to a potential reversal to the upside. The same is true for our shooting star. If you see one in the middle of a chart, it's a minor warning. But if you see that shooting star form precisely as the price rallies up to a known resistance level, a ceiling it has failed to break through before, the signal becomes incredibly potent. The chart is screaming that the market has reached a historical selling zone, and a pattern has just appeared showing that buyers tried to break through but were violently rejected. This is the beginning of reading the language of the charts. It's not about memorizing dozens of patterns with fancy names. It's about understanding the simple human story of greed and fear, buying and selling, that each pattern tells. And more importantly, it's about learning to listen for those stories when they are being told at the most critical locations on the map, the floors and ceilings where the biggest battles are won and lost. Once you can do this, once you can see a bullish engulfing pattern at a key support level and understand the story it's telling, you've moved beyond just looking at lines and colors. You're starting to read the collective psychology of the market. But there's another layer to this story. Another dimension that can change the meaning of everything you see. A battle that takes place over an hour looks very different from one that takes place over a week. The element of time. How we view these patterns across different time frames is the key to unlocking a much deeper, more panoramic view of the market's true intentions. This is where the market's story splits into 1,000 different novels, all happening at once. Imagine you're standing on a beach. You can watch the tiny ripples lapping at your feet. That's the 1-minute chart. It's constant motion, chaotic, and tells you very little about the ocean itself. Now lift your gaze and watch the waves crashing on the shore. That's the hourly chart. You see a rhythm, a pattern of ebb and flow. Finally, step back and consider the tide. The slow, powerful, almost imperceptible rise and fall of the entire water level over many hours. That's the daily or weekly chart. The tide is the most powerful force in the ocean. A single wave might crash onto the beach, but the tide will determine whether the water level is ultimately rising or falling. Most beginners spend all their time watching the ripples, getting tossed around by the noise, wondering why they keep getting pulled out to sea. They see a big green candle on a 5-minute chart and think a tidal wave of buying is coming, when in reality, it's just a small wave crashing ashore while the tide itself is silently, powerfully pulling out. The key to chart reading isn't just seeing the patterns, it's understanding on which canvas those patterns are being painted. This concept is called multi-time frame analysis, and it's less of a technique and more of a philosophy. It's the difference between looking at a single tree and seeing the entire forest. Let's break down these time frames into 3 main categories. First, you have the high time frame charts. Think the daily, the weekly, even the monthly. These are the generals of the market. They move slowly, deliberately, and with immense weight. Trends on these charts can last for months or even years. They are driven by massive fundamental forces, things like interest rate policies, national economic health, and global capital flows. When you look at a daily chart, you are seeing the market's tide. This is the big picture strategic view. Position traders and long-term investors live here. They are placing their bets on the fundamental direction of a currency pair over a long period. For a beginner, the daily chart is your North Star. It tells you the overall dominant direction of the market. It's your first and most important read. Is the tide coming in? Or is it going out? Next, we have the medium time frame charts, the 4-hour and the 1-hour. These are the commanders on the battlefield. They operate within the grand strategy set by the generals on the daily chart. These charts show you the waves. If the daily chart shows a strong uptrend, a rising tide, the 4-hour chart will show you the series of waves pushing higher, each one followed by a temporary pullback. This is the realm of the swing trader and the day trader. They're not trying to predict the tide. They're trying to ride the most powerful waves in the direction the tide is already moving. This is where you start to identify more immediate opportunities, specific areas to watch, and the structure of the market within a given week or day. You can see the market breathing on these charts, the inhale of a rally and the exhale of a consolidation. Finally, we have the low time frame charts, the 15-minute, the 5-minute, the 1-minute. These are the soldiers on the front lines. This is where the action is fast, chaotic, and filled with noise. This is the realm of the scalper, traders who are in and out of the market in minutes, trying to capture tiny movements. These are the ripples on the waves. For a beginner, this is the most dangerous place to be. Why? Because the signals here can be incredibly misleading if you don't have the context of the higher time frames. A strong-looking downtrend on a 5-minute chart might be nothing more than a tiny, insignificant ripple on the surface of a giant wave that is, in turn, being carried by a massive rising tide. Trading on these time frames without consulting the higher ones is like trying to navigate a ship in a storm by only looking at the compass. The needle is spinning wildly, and you have no idea which direction is truly north. So, how do professionals use this information? They don't just pick one time frame and ignore the others. They link them together in a process called top-down analysis. It's a systematic way of looking at the market, starting from the forest and working your way down to the individual trees. It's a filtration process. Step 1 is always the high time frame, usually the daily chart. You look at it with one question and one question only. What is the dominant trend? Is the price making a clear series of higher highs and higher lows, indicating an uptrend? Or is it making lower lows and lower highs, a downtrend? Or is it trapped between two levels going nowhere? This first step establishes your bias. If the daily chart is in a clear, undeniable uptrend, your primary mission is to look for reasons to buy. Your default mindset becomes bullish. You are deciding to swim with the tide, not against it. Trying to sell in a powerful daily uptrend is like trying to paddle a canoe up a raging river. It's possible for a moment, but it's exhausting, low probability, and a single mistake can send you flying backward. Once you have your bias from the daily chart, let's say it's an uptrend, you move to step 2, the medium time frame like the 4-hour or 1-hour chart. Your job here is not to question the trend, but to find the best possible location to join it. Remember, even in a strong uptrend, the market doesn't move in a straight line. It moves in waves. It pushes up, then pulls back to gather more energy, then pushes up again. On the 4-hour chart, you are looking for those pullbacks. You're waiting for the price to take a breather. You're not chasing the price when it's flying high. You're waiting patiently for it to come back to an area of value, like a tourist waiting for the tour bus at a designated stop, not chasing it down the highway. This is where you start to identify specific price levels that could act as a launching pad for the next wave up. After you've identified the overall direction on the daily and a potential area of value on the 4-hour, you move to step 3, the low time frame like the 15-minute chart for your entry trigger. This is the final confirmation. This is where you zoom in on that bus stop and look for the bus to actually slow down, for the doors to open, and for the driver to signal that it's okay to get on. On the 15-minute chart, you're looking for the pullback to end. You want to see the selling pressure dry up. You might see the candlesticks get smaller. You might see a bullish engulfing pattern form. You might see the price finally start to tick higher. This is your signal that the exhale is over, and the market is about to take its next big inhale, continuing the uptrend you first identified on the daily chart. Think about the story of two traders. Trader 1, let's call him Mark, only looks at the 5-minute chart of the euro versus the dollar. He sees 3 big red candles in a row and jumps into a short position, thinking the price is about to collapse. He gets stopped out 20 minutes later as the price screams upward. He's frustrated, confused, and blames the market. Trader 2, Sarah, starts on the daily chart. She sees the euro/dollar has been in a powerful textbook uptrend for 3 weeks. Her bias is set. She is only looking for opportunities to buy. She then clicks down to the 4-hour chart. She sees the price is in the middle of a healthy pullback, approaching a level where it had found support twice before. She sets an alert for that price level and waits. When the alert goes off, she zooms into the 15-minute chart. She watches as the selling momentum slows, and then she sees it. A beautiful bullish pin bar, a sign of rejection. The sellers tried to push it down, but the buyers, aligned with the daily trend, came roaring back. That is her signal. She enters a long position. Mark was fighting the tide. Sarah was waiting for a wave to carry her in the direction the tide was already flowing. This is the difference. It's not about being smarter. It's about having a better process. It's about having perspective. This top-down approach gives your trading a structure. The daily chart tells you which direction to trade. The 4-hour chart tells you where to look for a trade. And the 15-minute chart tells you when to execute the trade. Direction, location, timing. By filtering your decisions through these layers of time, you systematically align yourself with the market's most powerful forces, and you filter out the vast majority of the distracting, low-probability noise that traps so many beginners. You stop seeing the chart as a chaotic mess of wiggling lines and start seeing it as a structured map with highways, main roads, and local streets. Now that we understand the canvas and how to choose our perspective, the next step is to learn how to draw the fundamental lines that define the entire battlefield. These aren't just random lines. They are psychological barriers where the great wars of the market are fought and won. We're talking about support and resistance. Imagine the chart in front of you is a multi-story building. The price is a bouncing ball, and right now it's on the third floor. The floor beneath it is support. It's a solid foundation where the ball tends to bounce back up. The ceiling above it is resistance. It's a barrier that the ball struggles to break through, often getting knocked back down. This is the simplest, most powerful concept in technical analysis. Support is the floor. Resistance is the ceiling. These levels are created by the collective memory of the market, every trader, every bank, every algorithm remembering where the price turned around last time. Let's start with the floor support. Support is a price level where demand is thought to be strong enough to prevent the price from falling further. Think of it as a psychological price point where a wave of buyers jumps into the market. Why? For a few reasons. First, you have the bargain hunters. These are traders who have been waiting for the price to drop to a level they consider cheap. They see the price approaching a known support level and think, "This is my chance to buy at a discount." Their collective buying pressure creates a dam against the selling pressure, and the price bounces. Second, you have traders who are covering their short positions. These are people who bet the price would go down. As the price nears a strong support level, they get nervous. They know this is a point where the market has reversed before. To close their bet and lock in their profits, they have to buy back the currency pair. This buying action adds even more fuel to the bounce. Support isn't just a line. It's a zone of confluence where different market participants, for different reasons, all decide to buy at the same time. So how do you find these floors on your chart? You look for the valleys. You scan the historical data and identify the swing lows, the points where the price stopped falling and started rising. If you can connect two or more of these swing lows with a horizontal line, you've potentially identified a support level. The more times the price has touched this level and bounced off it, the more significant that level becomes. A level that has been tested twice is noteworthy. A level tested 3, 4, or 5 times becomes a fortress in the minds of traders. It's a proven battleground where the buyers have consistently won. When you draw this line, remember it's not a perfect razor-thin laser beam. It's an area, a zone. The market is driven by human emotion, not perfect math. So prices might dip slightly below your line before rocketing back up. Think of it as a thick concrete floor, not a fragile sheet of glass. Now let's look up at the ceiling. Resistance. Resistance is the mirror image of support. It's a price level where selling pressure is strong enough to overcome buying pressure, causing the price to turn back down. It's the point where sellers overwhelm the buyers. The psychology is the exact opposite of support. As the price approaches a known resistance level, traders who think the currency is overvalued or expensive start to sell. They believe the rally has run its course and it's a good time to bet on a price drop. At the same time, traders who bought at a lower price see this ceiling approaching and decide it's time to take their profits off the table. To close their winning by trade, they have to sell. This wave of profit-taking adds a huge amount of selling pressure to the market, often creating a powerful rejection from that level. Just like support, resistance is a psychological barrier built on the market's collective memory of where previous rallies have failed. To find resistance, you do the opposite of what you did for support. You look for the peaks. Scan your chart for the swing highs, the points where the price stopped rising and started falling. Connect two or more of these peaks with a horizontal line, and you have a potential resistance level. And just like support, the more times a resistance level has been tested and has held firm, the more powerful it is considered to be. It becomes a self-fulfilling prophecy. Traders expect the price to turn at that level, so they sell, which causes the price to turn at that level. And again, always think of it as a resistance zone, not a single price point. The ball might push into the ceiling a little, creating a small crack, before gravity takes over and pulls it back down. Now, here's where it gets truly fascinating. This is the concept that separates beginners from those who are starting to understand the market's language. The floor can become the ceiling, and the ceiling can become the floor. This principle is called role reversal, and it is one of the most reliable phenomena you will see on a chart. Let's go back to our building analogy. The price is bouncing between the floor, support, and the ceiling, resistance, on the third floor. But what happens if a huge wave of selling pressure slams the ball down with so much force that it crashes right through the floor? Suddenly, you're on the second floor. Now look up. Where is the ceiling? The ceiling of the second floor is the floor of the third floor. What was once support has now become resistance. This is the role reversal. When a support level is decisively broken, it often transforms into a new resistance level. The psychology behind this is brilliant. Imagine the traders who bought at the old support level, expecting a bounce. When the price crashed through, they were suddenly trapped in a losing trade. They're panicking, hoping for a chance to get out without a major loss. If the price rallies back up to their original entry point, that broken support level, what do? They sell. They close their position at break-even, breathing a sigh of relief. This wave of break-even selling creates a new wall of supply right where the old floor used to be. At the same time, new traders who saw the breakdown now view that old support level as a prime opportunity to initiate a sell trade, adding even more pressure. The old battlefield where buyers once stood strong is now occupied by an army of sellers. The exact same thing happens in reverse. If the price ball is pushed with so much buying force that it smashes through the ceiling of the third floor, it's now on the fourth floor. What was once the ceiling, the resistance, has now become the new floor, the new support. Why? Think of the sellers who were betting against the market at that resistance level. When the price blew past them, they were caught in a losing trade. They regret their decision. If the price dips back down to that level, they might buy to close their position and limit their losses. More importantly, the buyers who missed the initial breakout see this dip as a second chance. They think, the market proved it was strong enough to break that ceiling. Now it's pulling back, giving me a perfect opportunity to buy at a good price. They step in and buy at the old resistance level, turning it into a new foundation of support. Understanding this role reversal is like getting a cheat code for reading the market's intentions. It helps you identify high-probability areas where the price might turn. A very common pattern that experienced traders look for is the break and retest. This is when the price breaks through a key resistance level, pulls back to retest that same level as new support, and then continues its upward journey. That retest is often seen as a confirmation that the old ceiling is now a solid new floor, providing a more confident entry point for a potential trade. So when you look at a chart now, don't just see a squiggly line. See a story. See a building with floors and ceilings. Identify the major support and resistance zones based on historical peaks and valleys. Watch what happens when these levels are approached. Does the price respect them and bounce away? Or does it break through? And if it breaks, watch closely to see if it comes back to retest that broken level from the other side. These horizontal lines form the basic architecture of any chart. They are the fixed reference points in a world of constant motion. They show you where the major battles between buyers and sellers have been fought, and where they are likely to be fought again. Mastering the art of drawing and interpreting these zones is non-negotiable. It's the foundation upon which all other technical analysis is built. But markets don't just move sideways between a floor and a ceiling forever. They trend. They move in powerful waves, either up or down. So what happens when the floors and ceilings are not horizontal but sloped? What happens when the price is making consistently higher floors and higher ceilings, or lower floors and lower ceilings? To map that kind of environment, we need to add another tool to our arsenal. We need to go beyond the horizontal and learn to draw the lines that define the market's direction. We need to talk about trend lines. Trend lines are, in essence, support and resistance with a sense of direction. If horizontal levels are the flat floors and ceilings of a building, trend lines are the escalators and ramps. They don't just tell you where price might stop. They tell you the angle at which it's been moving. They give the market structure a slope, a gradient, a trajectory. And learning to draw them is like learning to read the invisible currents that guide the flow of price. Let's start with an uptrend. We defined this earlier as a series of higher highs and higher lows. It's that classic staircase climbing up the chart. To draw an uptrend line, you ignore the highs for a moment and focus only on the lows, the points where the price dipped before climbing again. You find at least two of these significant swing lows, and connect them with a line that extends out into the future. Ideally, you want to find 3 or more touches to confirm the line's validity. This line now acts as a rising floor, a dynamic level of support. Each time the price comes down to touch this line and bounces off, it's a sign that buyers are still in control, stepping in at progressively higher prices to defend the trend and push it further upward. The trend line visually represents their continued optimism. Now let's flip it. A downtrend is a series of lower lows and lower highs, the staircase heading down to the basement. To chart this descent, you do the opposite. You ignore the lows and connect the highs, the peaks where price rallied before falling again. You connect at least 2, preferably 3, of these swing highs with a descending line. This line now acts as a sloping ceiling, a dynamic level of resistance. As the price tries to rally, it hits this ceiling and gets pushed back down. Each successful rejection from this line reinforces the idea that sellers are the dominant force, willing to sell at progressively lower prices and keep the downward momentum going. This line is the visual story of their control. So, how do you actually draw these lines correctly? This is where art meets science. The first rule is a classic piece of market wisdom. 2 points make a line, but 3 points make a trend. A line drawn between just 2 points is speculative. It's a hypothesis. But when the price moves out and comes back to touch that exact line a third time and reacts to it, that's validation. That's the market acknowledging your line. Suddenly, countless other traders are seeing the same line, which gives it a kind of self-fulfilling power. The second rule is perhaps the most important for a beginner. Don't force it. If you have to squint, zoom in and out, and cut through the middle of 5 different candles to make a line fit, it probably isn't a valid trend line. The most powerful trend lines are often the most obvious ones. They should jump out at you. The market is a story, and the best trend lines are the clear, bold chapter headings, not the tiny footnotes you have to search for. This brings up a common question. Should you draw your lines connecting the wicks of the candles or the bodies? The wicks, or shadows, represent the absolute highest and lowest prices reached in a period. The bodies represent the opening and closing prices. There's no single, universally agreed upon answer, and you'll find successful traders in both camps. However, a great starting point is to try connecting the wicks first. The wicks represent the absolute extremes of buying and selling pressure, the exact points where the market reversed. If you can draw a clean line connecting the tips of the wicks, you've captured the full boundary of the trend. If that looks messy, try drawing it across the bodies. The most important thing is consistency. Choose a method and stick with it for that particular trend line. Often, the market will tell you which is more appropriate by how cleanly the price respects the line you've drawn. The angle or steepness of the trend line also tells a story. A very steep trend line, one that looks almost vertical, often signals a frantic, emotionally driven move. While exciting, these trends are often unsustainable. Like a sprinter who can't maintain their pace for a marathon, a price that goes up too fast is prone to collapsing just as quickly. A more moderate, sustainable angle, say around 30 to 45 degrees, often indicates a healthier trend with a more stable balance of buyers and sellers, which has a higher probability of lasting longer. So, once you've drawn this line, what do you do with it? How does it move from a simple line on a chart to a tool for decision-making? First, it's used for confirmation. As long as the price of an asset in an uptrend stays above its rising trend line, the uptrend is considered intact. The story continues. For some traders, this is a reason to hold on to a position. Second, it can provide potential entry points. In a strong uptrend, pullbacks are normal. The price doesn't move up in a straight line. It breathes, climbs, then rests, then climbs again. Many traders watch for the price to pull back to the established uptrend line. That touch of the line is a potential area of opportunity. They see it as a lower risk area to join the prevailing trend, anticipating a bounce. The trend line acts as a dynamic buy zone, a moving floor where buyers have historically shown up. The same logic applies in reverse for a downtrend. A rally back up to a descending trend line can be seen as a potential area to initiate a short position, expecting the ceiling to hold and the downtrend to resume. But the most dramatic role a trend line plays is in signaling a potential end to the trend. This is the break of the trend line. Imagine our uptrend. The price has been bouncing off its rising floor again and again. But then one time it doesn't bounce. It falls and it closes decisively below the trend line. This is a significant event. The structure has been broken. The rule, price stays above this line, has been violated. For a trader who is long, this can be a clear signal to consider taking profits or exiting the trade. For other traders on the sideline, it's the first major warning that the balance of power may be shifting from buyers to sellers. A word of caution here. Beware the false breakout or the fake out. Sometimes price will briefly poke its nose below an uptrend line or above a downtrend line, only to snap right back into the trend. It's a trap. To guard against this, many traders wait for more confirmation. They don't just want to see the price touch the other side. They want to see a full candle open and close on the other side of the line. A decisive close provides much stronger evidence that the break is real and that a genuine shift in market sentiment is underway. Now, here is where we can start to see the real magic. What happens when we combine our new tool, the diagonal trend line, with our old tool, the horizontal support and resistance level? This is when the chart truly starts to speak in full sentences. Picture an asset in a strong uptrend, with price bouncing neatly off a rising trend line. But as you look to the left on your chart, you see a major horizontal resistance level looming above. A ceiling where the price was aggressively rejected weeks or months ago. As the uptrend line continues to guide the price upward, it gets closer and closer to that horizontal ceiling. The space between the rising floor and the flat ceiling begins to squeeze. This creates a pattern, an ascending triangle, where energy is coiling like a spring. The market is being forced to make a decision. Will the buyers be strong enough to finally break through that old ceiling? Or will the sellers at that level be too powerful, pushing the price down and breaking the uptrend line? The convergence of a trend line and a horizontal level creates a hot zone, an area of immense importance that virtually every trader is watching. The resulting breakout in either direction is often powerful and swift. By learning to draw trend lines, you're no longer just looking at a chaotic series of up and down movements. You are starting to see the underlying architecture. You're defining the battlefield. You see the path of least resistance, the sloping lines of defense, and the critical points where the battle between buyers and sellers is about to reach its climax. We've now covered the building blocks, the individual candles, and we've covered the structural beams, the horizontal floors, and the diagonal ramps. But what happens when the building blocks themselves form specific, recognizable arrangements on our charts? What stories do small groups of candles tell us? These are the footprints of the market, and learning to read them is our next step. We need to talk about candlestick patterns. These patterns are the market's body language. They are short stories told in just 1, 2, or maybe 3 candles that reveal the psychological battle between buyers and sellers. Think of it like a tug of war. The bulls, the buyers, are pulling the price up. The bears, the sellers, are pulling the price down. Every single candlestick pattern is just a visual summary of who won that tug of war in a specific moment and how decisively they won it. And by learning to read this body language, you're not predicting the future with a crystal ball. You are simply gauging the current sentiment. You're asking, is the buying pressure starting to look exhausted? Is selling pressure suddenly showing immense strength? These clues, these footprints, help traders assess probabilities. Let's start with the most dramatic patterns, reversal patterns. These are formations that suggest the current trend might be running out of steam and could be about to change direction. Imagine a currency pair has been falling for days. The chart is a sea of red candles. Everyone is selling. The sentiment is overwhelmingly bearish. Then suddenly you see a single candle that looks like a hammer. It has a small body at the top and a long lower wick that's at least twice the size of the body. What story is this hammer telling us? During that period, the bears were in complete control, just like they had been. They pushed the price way down, creating that long lower wick. It looked like another victory for the sellers. But then something changed. The bulls, who had been hiding, suddenly mounted a massive counterattack. They started buying with such force that they pushed the price all the way back up, not just erasing the seller's progress but managing to close the candle near where it opened, or even slightly higher. That long lower wick is a battlefield scar. It's the evidence of a failed bearish assault. It tells you that even though the price went low, it was aggressively rejected. The bears tried to push it into the basement, but the bulls threw them back up to the ground floor. A hammer appearing after a long downtrend is a signal that buying pressure is starting to emerge at these lower prices. It's the first whisper of a potential reversal. Now let's look at an even more powerful reversal signal, the bullish engulfing pattern. This is a 2-candle story. First, you have a red, bearish candle continuing the downtrend. It's business as usual. But the very next candle is a large, green bullish candle that completely engulfs the previous red candle. Its body is so big that it opens lower than the previous candle closed, and closes higher than the previous candle opened. The story here is one of complete domination. The bears had their moment, pushing the price down in that first red candle. But in the next period, the bulls didn't just show up. They kicked the door down. They opened the market with overwhelming buying pressure, completely erasing all of the sellers' progress from the previous period and then some. It's a total shift in momentum made visible. It's like one army being completely swallowed by a much larger, more powerful one. When you see this pattern at the bottom of a downtrend, It's a very strong indication that the balance of power may have just shifted dramatically from sellers to buyers. Of course, this works in the opposite direction too. Let's flip the script. Imagine a currency pair has been rallying for days. Green candles everywhere. The bulls are euphoric. At the very peak of this uptrend, a candle forms that looks like an upside-down hammer. It has a small body at the bottom and a long upper wick. This is called a shooting star. What's the story? During this period, the bulls, full of confidence, continued to push the price higher and higher, creating that long upper wick. It looked like another easy win. But then at those new heights, they hit a wall of sellers. The bears came out in force and slammed the price all the way back down, causing it to close near its opening price. That long upper wick is the story of a failed bullish assault. It's a sign of rejection. It shows that buyers tried to continue their rally, but sellers overpowered them decisively. It's a warning flare at the top of a mountain, suggesting the climb might be over. And just like the bullish engulfing, there is a bearish engulfing pattern. It's the evil twin. After a nice green candle in an uptrend, a massive red candle appears that completely engulfs the prior green one. It opens higher than the green candle closed, and closes way lower than the green candle opened. The story is a brutal one for the bulls. Their small victory was not just negated, it was obliterated by a tidal wave of selling pressure. It suggests the sentiment has flipped, and the bears are now in command. These engulfing patterns and hammers are powerful because they tell such clear stories of struggle and domination. But what happens when the story isn't about a clear winner? What happens when the bulls and bears fight to a perfect standstill? This brings us to one of the most important candles you'll ever see. The doji. A doji is a candle with a very small, almost non-existent body. The open and close price are virtually the same. It often looks like a plus sign or a cross. A doji tells a story of pure, unadulterated indecision. Imagine the tug-of-war. The bulls pull the price up. The bears pull the price down. They fight back and forth, creating long upper and lower wicks. But by the end of the session, when the bell rings, the rope is right back where it started. Neither side gained any ground. A doji on its own in the middle of a choppy market doesn't mean much. It's just noise. But the context of where a doji appears is everything. If a strong uptrend has been going on for a week and then suddenly at the peak a doji appears, that is a huge red flag. It signals that the powerful buying momentum that drove the price up is now gone. The bulls are exhausted. The market is pausing, uncertain of where to go next. This indecision at the top of an uptrend, or the bottom of a downtrend, is often the precursor to a reversal. It's the calm before the potential storm. There are even different flavors of doji that tell slightly different stories. A dragonfly doji has a long lower wick and no upper wick, looking like a T. The bears pushed the price way down, but the bulls pushed it all the way back to the opening price. It shows a strong rejection of lower prices. A gravestone doji is the opposite, an upside-down T. The bulls pushed the price way up, but the bears slammed it all the way back down. It shows a strong rejection of higher prices. Both are stories of indecision, but with a clear hint at which side won the battle within that session, even if the war ended in a draw. Now, this is the single most important point I'm going to make. You must burn this into your brain. No single candlestick pattern is a guarantee. Ever. Thinking that seeing a hammer means the price is guaranteed to go up is the fastest way to blow up a trading account. These patterns are not magic spells. They are tools for assessing probability. A bullish engulfing pattern at the bottom of a downtrend increases the probability that a reversal might occur. A shooting star at the top of an uptrend suggests a potential shift in sentiment. The key is to think like a detective, not a fortune teller. A single footprint in the snow is interesting, but a set of footprints leading towards a specific location, combined with other clues, starts to tell a real story. In trading, this is called confluence. A candlestick pattern becomes exponentially more significant when it appears at a location that is already important on the chart. A hammer pattern floating in the middle of nowhere is just noise. But a perfect hammer pattern that forms right at a major, historically proven price level where buyers have stepped in before? Now that is a high probability clue. That's a footprint appearing right where you expected to see it. Confirms your thesis. It's this combination of patterns with other tools of technical analysis that transforms simple shapes on a chart into a powerful decision-making framework. And understanding those key levels, those significant locations on the map where these battles are most likely to be won or lost, is our next critical mission. We've learned to read the short stories. Now we need to understand the landscape where those stories unfold. we need to talk about support and resistance. Think of the Forex chart not as a random squiggle but as a battlefield. And on any battlefield, there are key strategic locations, hills, bridges, fortresses, where battles are fought over and over again. These are the places where one side makes a stand, and the tide of the conflict can turn. In the world of charts, these strategic locations are called support and resistance. They are, without a doubt, one of the most fundamental and powerful concepts you will ever learn. Let's start with support. Imagine you're holding a rubber ball and you drop it. It falls until it hits the floor, and then what happens? It bounces. The floor provided support and reversed the ball's direction. In Forex, a support level is exactly that, a price floor. It's a price level where a downtrend can be expected to pause or reverse due to a concentration of demand or buying interest. As the price of a currency pair falls, it becomes cheaper and more attractive to buyers. At some point, the price hits a level where the buyers think, "This is a bargain. I'm stepping in." They start buying in large enough numbers to absorb all the selling pressure, and then overwhelm it. The selling stops, the buying takes over, and the price bounces back up just like that rubber ball. On a chart, you identify a support level by looking for previous lows. When you see a price fall to a certain level and then rally back up, it creates a swing low. If the price falls back to that same general area again in the future and rallies once more, you now have a potential support level. The more times the price touches this floor and bounces off, the more significant and respected that support level becomes. It's like tapping on a concrete floor. The first time, you're not sure how strong it is. But after it holds up 10 times, you start to have a lot more confidence in its strength. This is the market's memory in action. Participants remember that this level held before, and they anticipate it might hold again. Now let's look at the other side of the coin, resistance. If support is the floor, resistance is the ceiling. It's a price level where an uptrend can be expected to pause or reverse due to a concentration of supply or selling interest. Imagine that same rubber ball. You throw it up in the air. It flies up until it hits the ceiling, and then it falls back down. That ceiling is resistance. As a currency pair's price rises, it eventually reaches a point where sellers believe it's overvalued. They think, "This is a great price to sell at." At the same time, buyers who got in at a lower price might think, "I've made a good profit, it's time to cash out." This combination of new sellers entering the market and old buyers exiting creates a massive wave of selling pressure. This selling pressure absorbs all the buying demand and then overwhelms it, causing the price to fall. The ceiling holds and the price is rejected downwards. Just like with support, you identify resistance by looking for previous highs. When you see the price rally to a certain level and then fall back, it creates a swing high. If the price rallies back to that same general area again and gets pushed back down, you've identified a potential resistance level. And again, the more times this ceiling is tested and holds, the more significant it becomes. It's a fortress wall that has repelled multiple attacks. But here is where things get really interesting. What happens when the floor breaks? What happens when the ceiling shatters? This is where we see one of the most classic principles of technical analysis, the role reversal. When a strong support level is decisively broken, it often becomes a new resistance level. Think about the psychology. Everyone who bought at that support level believing the floor would hold is now in a losing position. Their bargain is now a liability. What do many of them do? They wait and hope for the price to rally back up to the price they bought at so they can sell and get out at break-even just to feel whole again. This desire to get out flat creates a huge pool of potential sellers right at that old support level. So when the price tries to climb back up, it hits this wall of sellers, this former floor, and is often pushed back down. The old support has become new resistance. The exact same thing happens in reverse. When a strong resistance level is broken, it often becomes new support. The ceiling becomes the new floor. Why? First, all the sellers who shorted at that resistance level, betting the price would fall, are now wrong. As the price moves against them, they are forced to buy back their positions to limit their losses, which adds more buying pressure. Second, all the buyers who were watching from the sidelines, waiting for a breakout, now see their chance. They often wait for the price to dip back down and retest that old ceiling, and they use that opportunity to buy. This combined buying pressure from panicked sellers and eager new buyers creates a new floor of support where the old ceiling used to be. This principle of support becoming resistance and resistance becoming support is a cornerstone of reading the market structure. Now, a critical mistake many beginners make is seeing these levels as razor-thin, exact lines. They're not. Support and resistance are better thought of as zones or areas. The market isn't a precise machine. It's a messy, emotional auction. Price might push a little bit past a level before reversing, or it might turn just before it gets there. So, when you're drawing these levels on your chart, think of them as thick crayon lines, not precise laser beams. It's the general area that matters, the zone where the psychology of the market is most likely to shift. So far, we've only talked about horizontal floors and ceilings. But the battlefield isn't always flat. Sometimes the most important strategic lines are sloped, moving with the flow of battle. This brings us to the concept of dynamic support and resistance. One of the most common ways to see this in action is with moving averages. A moving average is simply a line on your chart that shows the average price over a certain number of past candles. For example, a 50-period moving average calculates the average closing price of the last 50 candles and plots it as a continuously updated, smoothed-out line. In a trending market, these moving averages can act as powerful, dynamic levels of support and resistance. In a strong uptrend, for instance, the price will often pull back to a key moving average like the 50-period, find support on that moving line as if it were a rising floor, and then bounce off it to continue its upward journey. In a strong downtrend, the price might rally up to a moving average, hit it like a descending ceiling, and then be rejected back down. They provide a mobile, adaptive framework that moves with the price, showing you potential areas where a trend might continue. So why is all of this so important? Because support and resistance give you context. They are the map of the market. A single bullish candlestick is a piece of information. But a bullish candlestick forming right on top of a major support level that has held 5 times in the past? That's not just information. That's a compelling story. It tells you that you are at a historically significant location where buyers have previously shown up in force. These levels provide a framework for decision-making. They help traders identify areas of potential opportunity and risk. For example, some traders might look for buying opportunities near strong support zones, while others might look for selling opportunities near strong resistance zones. They can use these levels to frame their strategies, perhaps setting a stop-loss just below a key support level or a profit target just before a major resistance level. This is not about predicting the future with certainty. It's about identifying high-probability areas on the map where the market has shown its hand before. It's about understanding the psychology of supply and demand written directly onto the chart. We've learned to read the individual candles, the short stories of battle. Now, with support and resistance, we've drawn the map and identified the key strategic battlegrounds. We know where the major fights are likely to happen. But there's still one crucial piece of the puzzle missing. We can see the individual skirmishes and we know the terrain, but we don't yet know the overall direction of the war. Is the entire army advancing or retreating? Understanding that larger momentum, that prevailing current, is everything. We've identified the key battlegrounds. Next, we learn how to identify the direction of the war itself. We're going to talk about the single most important concept in all of trading, the trend. There's an old saying on Wall Street, and it's probably the truest thing ever said about the markets. The trend is your friend. But what does that actually mean? Forget charts for a second. Imagine you're trying to row a boat down a river. You have 2 choices. You can row with the current, letting the river do most of the work for you, moving you swiftly and easily towards your destination. Or you can turn your boat around and try to row against the current. You might make a little progress, but you'll be exhausted fighting every single inch of the way, and the moment you stop paddling, the river will just push you right back. The market is that river. The trend is the direction the current is flowing. Identifying it is the single most important skill you can develop. It's the context for every candle, every pattern, every level of support and resistance. Trying to trade against a strong trend is like trying to row upstream in a storm. It's possible, but the odds are heavily stacked against you. Aligning yourself with the trend is like catching a powerful wave on a surfboard. You're harnessing a force much bigger than yourself. So, how do we see this current on a chart? Surprisingly simple. Markets move in 3 directions: up, down, or sideways. That's it. And we have very specific visual definitions for each one. Let's start with the most optimistic one. The uptrend. An uptrend is defined by a series of higher highs and higher lows. Think of it like someone walking up a flight of stairs. They take a step up, creating a new high point. They rest on that step, which is a higher low point than where they started. Then they take another step up to an even higher high. And they rest again on an even higher low. Higher high, higher low. Higher high, higher low. That is the rhythm of an uptrend. On a chart, you'll see the price push up to a peak. We call that a swing high. Then it will pull back a little, creating a valley. We call that a swing low. In an uptrend, the next push-up will blast past the previous swing high, creating a higher high. The subsequent pullback will stop before it reaches the previous swing low, creating a higher low. This pattern is the visual signature of buyers being in firm control. Every time the price dips, buyers see it as a discount. They step in with more confidence, preventing the price from falling too far. And their buying pressure fuels the next leg up to a new high. As long as that staircase pattern continues, the uptrend is considered intact. Now let's flip it. The downtrend. As you can guess, it's the exact opposite. A downtrend is defined by a series of lower highs and lower lows. This is the staircase going down into the basement. The price falls to a new low point. It then tries to rally back up, but the rally is weak and fails to reach the previous high point, creating a lower high. From there, sellers take control again and slam the price down to a new lower low, breaking below the previous one. Lower low, lower high. Lower low, lower high. This is the footprint of sellers dominating the market. Every attempt by buyers to push the price up is met with overwhelming selling pressure. These rallies are seen by sellers as an opportunity to enter at a better price, and they push the market down with more force. This rhythm, this downward staircase, tells you the current is flowing strongly to the downside. But what if the market isn't climbing or falling? What if it's just stuck? This is the third direction. The sideways market, also known as a range or a consolidation phase. Imagine the price is a tennis ball bouncing between the floor and the ceiling in a very small room. It hits the ceiling resistance and falls. It hits the floor support and bounces back up. It's making roughly equal highs and equal lows. It's not creating a new higher high, nor is it creating a new lower low. It's trapped. This signifies a state of equilibrium, a temporary truce in the war between buyers and sellers. Neither side has the strength to push the price out of this box. The market is essentially taking a breath, coiling up energy, before its next major move. Identifying a sideways market is just as important as identifying a trend, because it tells you that the old rules don't apply. The strategy is different. Instead of riding a wave, you're watching a tug of war, waiting to see which side finally gives way. Okay, so we understand the theory. Higher highs and higher lows for an uptrend, lower highs and lower lows for a downtrend. But how do we make this practical? How do we visualize it on our charts? We use one of the simplest, yet most powerful tools in technical analysis: the trend line. A trend line does exactly what its name implies. It's a line you draw on your chart to make the trend obvious. For an uptrend, you draw the line by connecting the lows. You need at least 2 swing lows to draw the initial line, with the second low being higher than the first. You simply click on the first swing low and extend the line so it passes through the second swing low and then projects out into the future. This line now acts as a dynamic level of support. It is the floor of our ascending staircase. As the price continues in its uptrend, you will often see it come back down to touch this trend line and then bounce off it, as if it were a trampoline to launch its next move to a higher high. The more times the price touches and respects this line, the more significant that trend line becomes in the eyes of other market participants. For a downtrend, you do the opposite. You connect the highs. You find at least 2 swing highs, with the second being lower than the first. You draw a line connecting them and extending it down and out into the future. This line now acts as a dynamic level of resistance. It is the ceiling of our descending staircase. You'll often observe the price rallying up to touch this line, only to be rejected and pushed back down to a new lower low. This line visually captures the selling pressure that is capping every attempt at a rally. Now, a few critical points about drawing these lines. First, don't force it. If you have to contort the line and ignore several candles just to make it touch 2 points, then a clear trend probably doesn't exist. The best trend lines are obvious and clean. Second, the angle or slope of the trend line matters. A trend line that is almost vertical is often unsustainable. Think of trying to sprint up a cliff face. You can't do it for long. These extremely steep trends are prone to breaking dramatically. A more gradual 45-degree angle often suggests a healthier, more sustainable trend. Finally, and this is key, what happens when a trend line breaks? A break of a trend line is a major signal. It's a potential sign that the fundamental character of the market is changing. If an asset has been in a beautiful uptrend, bouncing off its trend line 5 or 6 times, and then suddenly the price slices right through that line and closes below it, that's a warning flare. Tells us the buyers are losing control. The staircase is broken. It doesn't automatically mean the price is going to crash, but it does mean the uptrend is, at the very least, in question. The momentum has shifted. The market might go into a sideways range, or it might begin the process of forming a new downtrend. Conversely, if a market has been in a brutal downtrend, and the price finally manages to push up and close above its descending trend line, that's the first ray of hope for the buyers. It's a signal that the sellers are exhausted. The downward momentum is fading. This break could be the very first step in a new uptrend. By identifying the trend and drawing a simple line, you transform your chart from a chaotic mess of candles into a coherent story. You can see the direction of the current. You can see the dynamic floor or ceiling that is guiding the price. And you can spot one of the earliest potential warnings that the current is about to change direction. This isn't about predicting the future. It's about understanding the present. It's about recognizing the path of least resistance and seeing where the market's energy is flowing. Before you ever look at a fancy indicator or a complex pattern, you must first answer the most basic question of all. Which way is the river flowing? Because everything else we do will be built upon that answer. So, how do we find the direction of that river? How do we look at a chart with all its chaotic spikes and dips and see the underlying current? It starts with learning to see the market's footprints. The most fundamental way to identify a trend is by observing the peaks and valleys the price leaves behind. It's a simple story of progress. Imagine the price is a hiker trying to climb a mountain. When the market is in an uptrend or a bull market, our hiker is making progress upwards. They'll climb for a bit, creating a peak. We call this a high. Then they'll get a little tired and take a break, walking down a little bit to find a resting spot. This creates a valley or a low. But here's the key. After that rest, they resume their climb and push past their previous high point. This creates a higher high. And when they take their next break, their resting spot is at a higher elevation than their last one. This creates a higher low. That's it. That's the very definition of an uptrend. A series of higher highs and higher lows. It's a visual staircase stepping up the chart. As long as the price continues to make a higher peak after each valley, and each valley is higher than the one before it, the uptrend is considered intact. The hiker is still climbing the mountain. Now let's flip it. What about a downtrend or a bear market? Our hiker has reached the summit and is now heading back down. They'll walk down for a while, creating a valley, a low. Then they'll get their breath back and make a small climb back up the hill, creating a little peak, a high. But this time they don't have the energy to get back to their previous peak. This new peak is a lower high. From there, they continue their descent, walking down past their previous valley. This creates a lower low. This is the signature of a downtrend. A series of lower highs and lower lows. A staircase heading down. As long as the market is making lower valleys and the bounces back up are failing to reach the previous peaks, the downtrend is in control. The hiker is consistently losing elevation. But what if the hiker isn't climbing or descending? What if they're just walking across a flat plateau? This is our third market condition. A sideways market, also known as a range or consolidation. In this scenario, the price is essentially bouncing between two horizontal levels. It hits a ceiling, a level of resistance, and falls back down. Then it hits a floor, a level of support, and bounces back up. It's not making higher highs or lower lows. It's just stuck. This isn't a bad thing. A ranging market is the market catching its breath. It's a period of equilibrium where buyers and sellers are evenly matched. Think of it as a coiled spring building up energy. Often, these periods of consolidation precede a powerful move up or down. The key is to recognize you're on a plateau, not a mountain slope. Now, just looking for these peaks and valleys can be a bit messy. So traders developed a simple tool to help visualize the trend line. It's exactly what it sounds like. For an uptrend, you simply draw a straight line connecting the valleys, the higher lows. Think of this line as a floor or a guardrail for the price. As long as the price stays above this ascending line, bouncing off it like a ball, the uptrend is generally considered healthy. For a downtrend, you do the opposite. You draw a line connecting the peaks, the lower highs. This line acts as a ceiling. As long as the price stays below this descending line, getting rejected every time it tries to rally up to it, the downtrend is in force. When the price decisively breaks through one of these trend lines, it's a signal that the trend might be changing. If the price in an uptrend slices down through its ascending trend line, it's a warning sign. Our hiker may have stumbled off the path. It doesn't mean the trend is over for certain, but it's the first major clue that the market's character is shifting. Trend lines are powerful because of their simplicity, But we can add another layer of sophistication with a tool called a moving average. Don't let the name intimidate you. The concept is incredibly simple. A moving average takes the average closing price over a specific number of candles and plots it as a smooth, flowing line right on your chart. Imagine you're driving on a winding, bumpy road. The moving average is like a GPS line that smooths out all the minor turns and bumps, showing you the general direction of the road. It filters out the noise and reveals the underlying trend. Traders use different time periods for their moving averages. Some popular ones are the 20, 50, and 200 period moving averages. A 50-period moving average, for example, calculates the average price of the last 50 candles. Shorter-term moving averages like the 20 react very quickly to price changes. They're like a sports car zipping around every turn. Longer-term moving averages like the 200 are slow and steady. They're like a giant cargo ship. It takes a tremendous amount of effort to change their direction. For this reason, many traders view the 200-period moving average as a major dividing line for the market's long-term health. When the price is trading above the 200 moving average, the overall sentiment is often considered bullish. When it's trading below, the sentiment may be seen as bearish. You can use them in the same way you use a trend line. In a strong uptrend, the price will often stay above a rising moving average, sometimes coming down to touch it and bounce off, using it as a dynamic moving floor of support. In a downtrend, the price will stay below a falling moving average, using it as a dynamic ceiling of resistance. One of the most watched events on a chart involves two moving averages crossing each other. For instance, when a faster moving average like the 50 crosses up and over a slower one, like the 200, it's an event known in some circles as a golden cross. This indicates that short-term momentum is accelerating upwards and is now stronger than the long-term average, a potential sign of a new, powerful bull market beginning. Conversely, when the 50 crosses down below the 200, it's often referred to as a death cross, signaling that short-term momentum has turned negative and could be the start of a major bear market. These are not crystal balls, but they are significant market events that capture the attention of institutions and individuals alike, reflecting a major potential shift in market psychology. Okay, this is where it all comes together. We know how to spot a trend using price action, trend lines, and moving averages. But there's one final crucial concept that separates amateurs from seasoned chart readers. It's called multi-time frame analysis. Think about it like this. You would never try to plan a cross-country road trip by only looking at a map of a single city block. You'd get the details of that block perfectly, but you'd have no idea which highway you're supposed to be on. To understand the real journey, you need to zoom out. You need to look at the state map, then the national map to see the major freeways. Charts work the exact same way. The market exists on all time frames simultaneously. A trend on a 5-minute chart could be nothing more than a tiny blip, a minor pullback on the daily chart. This is a trap many beginners fall into. They see an exciting uptrend on a very low time frame, jump in, and then get run over by the much larger, more powerful trend going in the opposite direction on the higher time frames. They were focused on a small city street while ignoring the freight train barreling down the interstate. The practice of multi-time frame analysis is about starting with the big picture first. This is called a top-down approach. You start by looking at a high time frame like the weekly or daily chart to identify the main river. Is the 200-day moving average pointing up or down? Are we making higher highs and higher lows on this macro scale? This is your primary direction. This is the current you want to be flowing with. Once you've established that main trend, you then zoom in. You go down to a lower time frame like the 4-hour or the 1-hour chart to fine-tune your entry. On this lower time frame, you look for a smaller trend that is moving in the same direction as the big trend. For example, if the daily chart is in a strong uptrend, you would wait for the 1-hour chart to have a temporary pullback, a small dip, and then start to show signs of moving up again in alignment with the larger daily trend. This is how you get the wind at your back. You're using the higher time frames to establish your bias. Are you a buyer or a seller? And the lower time frames to time your action. You're not fighting the current. You're waiting for a small wave to form in the direction the entire river is already flowing. This single habit, the habit of always checking the higher time frame before making a decision, can fundamentally change how you see the market. It provides context. It turns a chaotic, confusing chart into a structured map with clear highways and side streets. We've identified the trend, the prevailing current of the market. But knowing the direction is only half the battle. The other half is knowing where and when to act. In the final part, we're going to uncover the key landmarks on our chart, the specific price levels that act as magnets for price, the zones where battles between buyers and sellers are fought and won. These are the levels of support and resistance, and understanding them is the key to unlocking the timing of the market. Imagine a price chart as a multi-story building. Support is the floor. It's a price level where a downtrend can be expected to pause due to a concentration of demand. Think of it as a bargain bin. As the price falls to this level, buyers who were waiting on the sidelines see an opportunity. They think, wow, the euro is cheap at this price, and they start buying. This influx of buying pressure is often enough to stop the price from falling further, and sometimes even push it back up. The more times a price falls to a certain level and then bounces back up, the stronger that support floor is considered to be. It's like testing a floor by jumping on it. If it holds once, it's decent. If it holds 10 times, you trust that floor. Resistance is the ceiling. It's the exact opposite. It's a price level where an uptrend can be expected to pause or reverse due to a concentration of supply. As the price rises to this ceiling, sellers start to emerge. They might think, the price is getting a little too high, it's overvalued. Time to sell and take my profits. This selling pressure acts as a barrier, preventing the price from climbing higher. Just like support, the more times a price hits a resistance level and gets rejected, turning back down, the stronger that ceiling is. It's a battle line drawn in the sand by the sellers. Now here's where it gets incredibly powerful. Floors can become ceilings, and ceilings can become floors. This is one of the most fundamental principles of technical analysis. When the price, with enough momentum, smashes through a resistance ceiling, that old ceiling will often become the new support floor. Think about it. The bulls, the buyers, just won a major victory. They broke through enemy territory. Now, when the price pulls back, it often falls right to that old resistance line. But this time, the psychology has flipped. The same buyers who broke through it will now defend it, seeing it as a new, higher level of value. What was once a point of selling pressure is now a point of buying pressure. The same is true for support. If the sellers, the bears, manage to push the price through a support floor, that floor often transforms into a new ceiling. When the price tries to rally back up, it runs into that broken floor, but now from below. The psychology has shifted. Traders who bought at that level before it broke are now likely selling to get out at break-even, and new sellers see it as an opportunity to join the new downtrend. This role reversal dynamic is constantly playing out on every time frame, creating a predictable structure within the chaos of the market. So now let's put it all together. Let's take a step back and look at the masterpiece we have assembled. Over this series, we've given you the complete toolkit. We started with the basic building block, the candlestick. Each one is a story of a single battle between buyers and sellers. Then we learned how these candlesticks form patterns, like the engulfing pattern or the doji, which are like short sentences, giving us clues about a potential shift in momentum. We then zoomed out to see how these sentences form paragraphs, the market trends. Is the market in an uptrend with higher highs and higher lows? Or a downtrend with lower highs and lower lows? We learned to draw trend lines to visualize the direction and the slope of the market's journey. Next, we added our technical indicators, our analytical tools. We brought in the moving averages to act as a dynamic guide, helping us smooth out the noise and identify the underlying trend, even acting as dynamic support and resistance themselves. We added the relative strength index, the RSI, to be our momentum gauge, warning us when a currency pair might be overbought or oversold, like an engine's tachometer approaching the red line. And finally, today, we've layered on the foundational structure of the entire market: support and resistance. These are the key levels, the floors and ceilings that define the battlefield. So how does this all work in practice? Imagine you pull up a chart of the euro to US dollar. The first thing you see isn't random noise anymore. You see the language. You spot a clear uptrend, a series of higher highs and higher lows. You draw your trend line connecting the lows. You add a 50-period moving average, and you see the price is consistently staying above it, confirming your bullish bias. Then, you notice the price is approaching a major resistance level. You know this because you look to the left on your chart and see that 6 months ago, the price hit this exact level and sold off hard. This is a major ceiling. At the same time, you glance down at your RSI and see it screaming above 70, deep in overbought territory. The engine is redlining. Now, you have a confluence of signals. You have an uptrend, yes, but it's approaching a historically strong ceiling, and your momentum indicator is suggesting exhaustion. What do? You wait. You watch. You don't just jump in. You look for the story the candlesticks will tell. As the price hits that resistance, do you see large, powerful bullish candles trying to smash through it? Or do you see the candles getting smaller? Do you see long wicks on the top, a sign of rejection? Maybe you see a bearish engulfing pattern form right at that resistance level. Suddenly, you have a complete narrative. The market was in a strong uptrend, the paragraph, but it ran into a historical barrier, the chapter break. The momentum faded, the punctuation, and the candlesticks themselves told you the sellers were taking control, the final sentence. This is how you read a chart. It's not about one single thing. It's about combining these elements to build a high probability story about what might happen next. And this brings us to the most important lesson of all, one that transcends any chart or indicator mindset. Reading charts is not a crystal ball. It is not about predicting the future with certainty. Anyone who tells you they can is trying to sell you something. Chart analysis is the art and science of dealing in probabilities. It's about finding situations where the historical data and the current price action suggest a higher likelihood of one outcome over another. But there are no guarantees. Perfect setup can fail. A terrible setup can work. The market can and will do anything at any time. Your job as an analyst is not to be right 100% of the time. It is to have a system and edge that puts the probabilities in your favor over a large series of trades. This requires two things that no indicator can give you: patience and discipline. The patience to wait for all your criteria to align, to wait for that high probability setup, instead of forcing a trade out of boredom or greed. And the discipline to follow your plan, to manage your risk on every single trade, knowing that any one trade can be a loser. The greatest chart reader in the world will fail without proper risk management. That's a topic for another day, but understand this. Your ability to protect your capital is infinitely more important than your ability to pick a winning trade. So what now? Where do you go from here? You have completed the beginner's guide. You now possess a foundational knowledge that puts you light years ahead of most people who look at a financial chart. But this is the beginning of your journey, not the end. The next step is screen time. Open a charting platform. You don't need to risk a single penny. Use a demo account. Pull up any chart, euro to US dollar, Bitcoin, Apple stock, it doesn't matter. The principles are the same. Start identifying the things we've discussed. Find the trends. Draw the support and resistance lines. Watch how the price reacts to moving averages. See if you can spot candlestick patterns at key levels and watch what happens next. Do this over and over. You are training your eyes to recognize patterns, to see the language of the market fluently. You are building experience, the only true teacher in this domain. You started this journey looking at what seemed like an impossible series of random green and red lines. Now you see a story. You see the ebb and flow of fear and greed. You see the battles between buyers and sellers playing out in real time. You've learned the grammar, the vocabulary, and the structure of the market's language. The chart is a map and you now know how to read it. It doesn't tell you the destination with certainty, but it shows you the terrain, the potential paths, and the dangerous cliffs to avoid. The rest of the journey is up to you. Thank you for joining us on this deep dive. If this series has provided you with value, if it's opened your eyes to a new way of seeing the financial world, do us a favor and hit that like button. It tells the algorithm that this is the kind of educational content people want to see. And be sure to subscribe and turn on notifications, because our exploration of the markets is far from over. Most importantly, drop a comment below and let us know what you want to learn next. Is it risk management? Trading psychology? A deep dive into a specific indicator? You tell us. This channel is built for you. Now go, open a chart, and start reading the story.